Welcome to the Deep Dive. Today, we're digging into the Cameco Q3 2025 earnings call. And this one, well, it was really something. A real study in contrast, you could say.
Definitely. A paradox, almost.
Yeah, on one hand, you had some clear operational challenges, a bit of execution noise, and yeah, a headline financial miss.
Right.
But on the other hand, wow. A strategic move, an acceleration so big it feels like it could reshape the whole long-term picture for nuclear.
It's that classic investor puzzle, isn't it?
Yeah.
The results hit pre-market November 5th, and the stock reacted immediately, down about, 1.7% mid-morning?
That sounds about right.
Which totally reflects that short-term pain, the miss.
Yeah.
But like you said, those numbers came out just weeks after this huge strategic news dropped. News investors are probably still trying to figure out how to value properly.
Exactly. So our job today is to help you sort of reconcile those two things. The immediate, let's say, operational disappointment and this just massive strategic momentum building underneath.
Let's do it.
Okay, so let's start with the sting. The numbers that caused that initial drop. The market expected one thing, Cameco delivered another, especially on the bottom line. What were those headline figures that, spooked the street?
Well, the big one, the main driver for that negative reaction was definitely the earnings per share miss. Cameco reported adjusted EPS non-GAAP of just $2.07, 7 cents Canadian.
Okay, and what was the expectation?
Well, the consensus range was already pretty wide, actually, somewhere between $C.23 and $C.28. So coming in at $C.07, that's a huge miss. Really signals a big short-term shortfall.
Right. And revenue didn't help matters either, I imagine.
No, it contributed to that feeling of weakness. Revenue landed at $615 million. Now, that's down 15% from the same quarter last year, which was $721 million.
15%?
Yeah. So significantly below what analysts were looking for. And that double whammy, revenue and EPS both missing, that really set the immediate tone for the selling.
Which, for anyone following this space, raises the big question, how does that happen? I mean, the long-term story for uranium, the fundamentals, they seem stronger than ever.
Yeah, it's a fair question. And it really boils down to volume and timing. That's always the big variable in this business, right? They just had lower sales volumes in the quarter, both for uranium itself and for their fuel services segment. And that drop in volume just completely outweighed the benefit they got from better average realized prices.
So prices are good, but if you don't ship the stuff...
Exactly. If the product isn't delivered in that specific quarter, the revenue doesn't get booked then. Now look, this kind of quarter-to-quarter variability is normal in uranium because of delivery schedules. But the size of this miss, that's what fueled that short-term skepticism about their execution.
Okay, let's dig into that execution side a bit more then, because management did revise their production guidance for 2025. What were the specific challenges they mentioned that led to that cut?
Yeah, they did trim the outlook. Mostly it was down to development delays at their big operations, McArthur River and Key Lake specifically.
Okay.
These are complex, world-class facilities, and management basically acknowledged some logistical challenges, development just taking longer than planned. So now they're projecting their own share production for the year will be up to 20 million pounds. 20 million pounds.
Which is a noticeable cut from what they were saying before.
It is. And that's where that operational risk really lies, right?
Yeah.
Can they get that capacity ramped up efficiently when the demand is clearly picking up?
But, okay, even with those production cuts, the really interesting part was how they showed they could still meet their commitments. That flexibility seemed like a key advantage.
Oh, absolutely critical. And it really highlights the strength of their whole supply setup. They did tighten their overall sales and delivery guidance for the year slightly to between 32 and 34 million pounds. That's pretty steady, actually.
Right.
But the crucial part was how they plan to meet that. They significantly cut back their planned reliance on buying uranium in the spot market. They reduced planned market purchases down to up to 1 millibune. Previously, that was up to 3 millibune.
Ah, okay. So they're still delivering to customers, but instead of going out and buying potentially expensive uranium on the open market, they're using their own stuff.
Exactly. They're leaning hard on what they call supply sourcing flexibility, using their existing inventory, which they likely hold at a lower cost basis, using product loans, leveraging existing supply deals they already have in place.
Sure.
That's how a top-tier producer navigates this kind of volatility. You protect your margins by avoiding those high spot market buys if you can, but you absolutely keep your utility customers supplied. It really shows financial discipline even when operations hit a snag.
And that discipline, it seems to run right through to their balance sheet, too. That looks incredibly solid, which must signal some real confidence from management despite the quarterly wobble.
Oh, absolutely. Their financial position is rock solid. Liquidity is strong. They ended the quarter with $779 million in cash and equivalents, plus their big $1.0 billion revolving credit facility, still completely undrawn. Yeah, that's a balance sheet designed to handle bumps in the road. It lets them maintain their investment grade rating, be flexible, maybe even opportunistic.
And then there was the dividend. I mean, accelerating dividend growth right after missing earnings pretty badly. That feels like a deliberate message to the market.
Oh, it's absolutely a signal, a very deliberate one. The board declared an annual dividend of $24 per share, payable in December.
24 cents.
Yeah. And when management bumps the dividend, even with a quarterly volume miss like that, they're basically shouting to shareholders, look past this quarter, trust us. Our conviction in the long-term cash flow from our assets, from our strategy, it's completely unshaken. It's a vote of confidence in that future structural story, not the tactical noise of one quarter.
Which brings us nicely to the segment performance, and especially Westinghouse. Because even before this huge new partnership announcement, Westinghouse was already making a difference, wasn't it?
It really was.
Yeah.
I mean, look at the adjusted EBITDA numbers. The core uranium segment brought in $220 million. But the Westinghouse stake, where Cameco owns 49%, that contributed a really healthy $124 million share of adjusted EBITDA.
That's significant.
It is. Now, okay, on a net income basis, this segment showed a loss for Cameco's share, about $32 million. But that's mostly due to things like amortization, accounting stuff from the acquisition. The underlying cash flow, the EBITDA contribution, clearly shows the strength of that asset.
And that existing strength really just set the stage perfectly for the real bombshell news.
The structural game changer.
Yeah. Let's pivot to that now, that strategic catalyst. Because this is the story that, honestly, it defines the quarter, maybe the year, maybe even the next decade for them. That partnership announced in late October involving Westinghouse.
This is the news that just resets the baseline for the entire nuclear industry, potentially. Cameco announced this partnership with the U.S. government and Brookfield, their partner in Westinghouse.
Right.
And the goal is to dramatically speed up the deployment of Westinghouse reactors right here in the United States. And the scale they're talking about, the initiative is framed as representing an aggregate investment value of at least US $80 billion.
$80 billion.
Yeah.
I mean, just to put that in perspective for people, that's like the GDP of a decent-sized country. It's a staggering commitment.
It's enormous.
So what does having the U.S. government involved actually do for Westinghouse and its AP1000 reactor technology, practically speaking?
Practically, it tackles the single biggest obstacle that's been facing new large-scale nuclear builds, the financing risk. This commitment basically positions the AP1000 as the go-to gigawatt-scale large reactor solution, not just in the U.S., but it sends a signal globally. Having the U.S. government step in, acting as a facilitator, de-risking the capital, providing that long-term political backing, it removes what management often calls the next-of-a-kind financing problem.
Right. That's the barrier where, the first new reactor design built in ages costs so much and seems so risky that banks just get nervous.
Precisely. So this U.S. commitment, it validates the technology. It makes it much easier for other countries around the world, whether they're chasing energy security or trying to hit aggressive climate goals, to choose the AP1000 with a lot more confidence. And obviously, that's a huge, huge long-term tailwind for Cameco's fuel business down the road.
Let's quickly touch on the deal structure, though, because the U.S. government doesn't just get a piece of Westinghouse for free, right? It's tied to performance.
Yes. And the mechanics there are absolutely critical for how you value this whole thing.
Yeah.
The U.S. government's interest, it's performance-based. Their 20% equity stake in Westinghouse only vests after the current owners, Cameco and Brookfield, get back the first U.S. $17.5 billion in cash distributions.
$17.5 billion.
Yeah. Distributions tied specifically to the success of the business after they acquired it. That threshold basically reflects the massive value Cameco and Brookfield believe they've already built or unlocked in Westinghouse. It ensures they capture that initial upside first.
Got it. And management was also really clear, weren't they, that this partnership is just about accelerating the Westinghouse reactor side. It doesn't directly involve Cameco's core uranium mining or fuel services segments?
Yes, they made that distinction very clear, and that's important for the market to understand. I mean, obviously, more reactors getting built means guaranteed long-term growth and demand for Cameco's fuel products. But the partnership itself is laser-focused on deploying the technology. It's a highly targeted strategic move.
Okay, so shifting gears slightly, back to the broader market picture. Despite this absolutely monumental strategic win, management on the call still sounded really committed to supply discipline. Why are they holding back on just flooding the market with uranium when the demand signals look so incredibly strong now?
Yeah, it's interesting, isn't it? They are definitely playing the long game here, aiming for structural price increases, not just temporary bumps. Management argued pretty strongly, actually, that the current long-term uranium price, which was hovering around $45 a pound at the time of the call, it just doesn't reflect the real cost of bringing on new supply.
Right. The replacement costs.
Exactly. Or the economics needed to justify huge new mine investments. And because Cameco sees itself as a reliable tier one high quality supplier, they basically asserted, look, we can already command premiums over that average price, and we should.
Okay, but if the demand is so solid structurally, why not just push McArthur River and Key Lake to the max right now? Why the restraint?
It's a very calculated decision. It's all about maintaining that supply discipline across the industry, or at least among the responsible players. They want to avoid making what they called heroic decisions, just to pump out maximum pounds today, not until the market price truly reflects that fundamental replacement cost. They were actually openly critical of what they termed undisciplined producers, the ones making hyper promises about future production that frankly often doesn't materialize on time or on budget.
And those promises confuse the utilities.
That's their argument. Those hyper promises, they say, just muddy the waters for utility buyers and makes them delay signing the necessary long-term contracts at higher prices, hoping some cheap supply miracle shows up. Cameco is basically waiting for the utilities to face reality and lock in supply long-term.
And that hesitation, that sort of game being played between producers and utilities, it extends beyond uranium itself, right? Into conversion and enrichment, too.
Oh, definitely. You heard similar themes there. Conversion pricing, for example, is at historic highs. But management pointed out that the crucial contract tenor is still missing.
Tenor meaning the length of the contracts.
Exactly. The long-duration commitments utilities need to sign to justify massive, expensive capital projects, like restarting the Springfields conversion facility in the UK, for example. Utilities are, well, they're trying to be clever. They offer shorter-term contracts, hoping to stimulate just enough capacity to maybe get prices down again later.
And Cameco and its partners are saying no deal on that basis.
Pretty much. They're demanding that long-term commitment to de-risk the huge capital investments required. It's a standoff, waiting for the utilities to blink first and sign longer deals at today's higher prices.
Got it. And just before we move to our last segment, there was a quick technical update on the enrichment side too, right? GLE.
Yeah, a positive note there. The Global Laser Enrichment Project, GLE, that achieved Technology Readiness Level 6, or TRL-6.
Okay, and what does TRL-6 mean for investors?
Basically, it's a key engineering milestone. It means the core laser enrichment technology is proven, it's ready for system integration, and it's capable of enriching uranium reliably to the standards utilities require. So effectively, it removes the main technology risk from the project. That clears the way for them to have more serious substantive contract discussions with utilities about future enrichment services.
Right. So this whole call, it really just boils down to this incredible split, doesn't it? You've got the tactical near-term execution risk, the EPS miss, the production delays.
The immediate stuff.
Completely overshadowed or at least counterbalanced by this generational strategic reward the U.S. government basically underwriting or facilitating at least $80 billion in new reactor builds using Westinghouse tech.
The contrast really couldn't be much sharper. It's like today's noise versus tomorrow's almost guaranteed structural demand picture.
Which I think leads us perfectly into our final segment. This is not financial advice. This is where we take this kind of extreme situation, this divergence we've just unpacked, and pitch a high conviction, maybe volatile, possibly even outrageous trade idea based on it. Standard disclaimer applies, of course.
Let's hear it. The setup is certainly interesting.
Okay, my pitch committee. We've got clear tactical weakness, right? The stock dipped because of a volume miss, near-term uncertainty.
Okay.
And we've got absolutely massive strategic strength, this huge multi-year tailwind coming from that $80 billion Westinghouse ecosystem. To me, this just screams for an option strategy to kind of exploit that difference in timelines and volatility.
Okay, so using the short-term dip as an entry point, but funding it with the conviction in the long-term story. I'm following. What are the mechanics?
So the idea is to play both ends. You could potentially fund the trade by selling a short-term tactical put spread. You'd target the implied volatility spike and the downside pressure right after the earnings miss, use that premium generated to help pay for a longer-term, multi-year, probably deep out of the money, long call spread on the stock. Focus it maybe 2-3 years out to capture that value realization from the Westinghouse deal really kicking in.
Interesting. So you're saying the immediate noise, the Key Lake delays, the EPS miss, create some tradable selling pressure, maybe defines a near-term floor.
Right.
But you're betting that floor is ultimately supported by the strategic value. And the real upside comes from the near certainty that this U.S. government commitment paves the way for decades of Westinghouse growth, distributions, and crucially, accelerates that massive future fuel demand that probably isn't fully baked into the stock price yet.
That's the bet, exactly. It's a structured wager that the Westinghouse acceleration story is basically a lock over the next, say, 36 months. That makes the current operational hiccups feel temporary, transient, and importantly, potentially tradable right now.
A bold play on the strategic certainty overwhelming the tactical noise.
Precisely. So, just to wrap up our deep dive on the Cameco Q3 2025 call, the main takeaway, I think, is pretty clear. Yes, there's operational execution risk. Management needs to deliver on those production ramps. Investors will watch that closely.
Sure.
But the long-term structural story for Cameco, it looks incredibly robust, highly differentiated, and frankly, it just got a massive booster shot from this U.S. government partnership backing Westinghouse.
Yeah, and if you connect that to the really big picture, I mean, the scale of this U.S. commitment to nuclear, driven by everything from energy security to, AI data center power demand, it's undeniable. It really does set the stage for decades of guaranteed demand growth. So the provocative thought I'd leave you with is this. We heard management talk about how the uranium market contracting has been, sluggish, cautious, utilities playing games.
Right.
Given this huge, verifiable signal of accelerated future demand from the Westinghouse deal, how quickly does that change? How quickly are those utilities forced to abandon the caution and scramble to lock up long-term supply for this new reality that seems to be arriving much faster than maybe they expected?
That shift in utility behavior, that feels like the very next domino to watch.
Absolutely. Well, thank you for joining us for this deep dive today. We really appreciate you tuning in.